All right, take 17. I've been tasked with comparing apples to apples, a VA loan with a conventional loan for the same property, same buyer, same qualifications. Um, I used $450,000 for the purchase price with 20% down because for some reason the experts say you need 20% down to buy a property. And that's false right there in more ways than one, and out of scope for this example, but for right now we're going to show 20% down. Now, the reason they say the VA loan is not as good of an option is because unless you're exempt, the veteran's going to pay a funding fee for that loan. And for 20% down on this size property, that comes out to $5,040 paid cash or usually financed, which is added to the balance. What I'm saying is because the loan is guaranteed for performance, the interest rates are lower, therefore the payment's lower, therefore the benefit to the borrower is way greater than that fee. Now, to be perfectly honest, let's go back here. For the first 4 years, you see that the conventional loan will perform a little bit better for the short term because even though the payment's higher, it takes a few years for the VA loan savings to catch up to the costs of that funding fee. So this calculates it to 4 years. So over the life of a loan, the average loan is like 7 years. People refinance or sell. But if you were to show the whole thing over 30 years, I mean, see that little section there? Small compared to the rest of the thing. So let's go over some of the specifics here. Okay. So the payment on the VA loan will be a little bit cheaper than the conventional loan, $53. And if you want to look over time, like I said, the break even's at 4 years. So you can see that here, right there's difference in lowest cost. It's about the same. But if you spread it out over, let's say 10 years, there you go. It's the VA loan is almost $7,000 in your favor. And that's accounting for the funding fee just in 10 years alone. And I mean, that's really the crux of it, a little bit of monthly savings, but really a lifetime interest savings on the loan that will eat up that cost, right? So one thing to look at is, hey, apples to apples, what if I took that monthly savings at $53? Is that what it was? $53. And what if I applied it, towards the principal? What would that do for me? Okay. Well, look at these computers. Okay. Now we put that $53, we put it towards the mortgage every month. So the monthly payment is the same. See, $1,456. What that's going to do is kind of accelerate the payoff. You're paying more principal up front. So you can see over 5 years, 10 years, it's a little bit more, all the way up to, to be honest, this is ridiculous because no one's going to keep their loan for 29 years. But the point is I want to show you how superior it is. So if you look at this, and this is where it gets cool, 29 years down the road, again, it's a long time, the VA loan will be not only almost $27,000 less expensive in cost, but it's paid off in full in 29 years. So what is that? $1,456 a month over a year is about $17,000. So life of the loan, it is what? 17 and 26, 30, 40, that number in your favor, right? So long-term, it's gonna benefit you. Another way to look at it is, what if I did not make that $53 principal payment and instead, let's see this transfers, there we go. What if I were to put it into some kind of interest-bearing account that accrues interest and compounds it? Well, $53 a month, let's put it over 30 years just to see the whole chart. And let's say a 5% return over long term, which is probably about right. So you can see that if you keep that money in your pocket and invest it, again, it's only $53, but it will give you a return. So after 5 years, you're up like $400 something. After 10 years, you're up that. So if you go back to the loan comparison, if you were to invest that money, well, in 10 years, the VA loan is almost $7,000 less expensive. And then the same amount of time, if you invest that, well, you're going to be up about another $2,000 on your investments. Again, not significant, but the point is, it's in your favor. Let's do something else. Let me see if I can bring it over here. Is this going to work? Okay. Now, let's compare a 20% down VA loan, sorry, a 20% down conventional loan with 0 down VA loan. Crazy, right? Well, the payment's going to be higher. The rate's the same. Your funding fee is like double, right? Your payment's higher, but you keep your cash. You keep your $90,000 liquid. So even though the monthly payment is $315 more for the VA loan, this gets a little complicated. So the loan itself doesn't really break even. You can see that the conventional loan is cheaper because it's a lower interest rate on the bigger loan, but it's such a larger balance in that $10,000 funding fee. But let's just look at what you can do with that $90,000. Let's look at 10 years. So 10 years down the road, including the funding fee, the conventional loan is about $18,000 less expensive. So it's going to cost you that much less. Now, if you put that $90,000, let me just make sure this is, let me do that. Again, compounding interest account. Don't touch it. What did I do? 10 years? 10 years. After 10 years, show table. Your 90,000 is now 148. So you've earned, what is that? $58,000 of interest over 10 years. That's amazing. So even though the VA loan costs $18,000 more, your money was actually working for you. Your house is still going to appreciate. Your loan doesn't affect your home value. So your $18,000 in cost, what you paid is to earn the almost $60,000 of interest. And then what you can do after 10 years is, if you really want to pay off your house, or maybe 15 years, you take that lump sum that you've accumulated and you can use that to pay off your principal. So you can actually pay off your house a little bit faster that way. I think it's a little too complicated for these charts here to show you exactly where, but there is a point where that compounded balance, interest earning balance, will be enough to pay off the principal, because the principal is going to slowly go down over time. Your value is going to, doesn't even come into play when you're just trying to pay something off. But that $90,000 will A, be liquid, and B, be earning money for you. Now, one thing that's not in the numbers are the intrinsic value of the VA loan. Now, it's hard to imagine right now, because right now interest rates are super low. But in a different rate environments, when rates are a little bit higher, one of the amazing benefits of the VA loan is the ability to do an interest rate reduction refinance loan, which is a streamlined refinance loan going from VA to VA, as long as you meet certain savings requirements and interest rate. The fees are reasonable, where they recoup within 36 months, which is still a long time. And you have positive payment history. With that in mind, you're able to, what a lot of people are doing right now is refinancing their loans without appraisals, without inspections, without income or employment verifications. They're getting them done in like 2-3 weeks at most. That's one of the other benefits. The other benefit, which is not really talked about that much, is the ability for your loan to be assumed. That means down the road, a buyer of your property, if you're selling it, could apply to take over your mortgage, and they have to come up with the difference for whatever the sale price is and your mortgage balance then. Like, for example, let's say you have this 360 balance and you pay it off in 15 years and your balance is 285, you sell it for 600,000. Maybe they can assume that 285 balance at today's rates in the twos and come up with the difference cash or some kind of secondary financing, whatever's available in the future, and take advantage of today's rates down the road. You can't do that with a lot of loans. Another veteran can actually take over the mortgage, and they can get an amazing rate, even though rates down the road may be a lot higher. So a couple different ways to look at it, but bottom line, the VA loan is going to perform a lot better than a conventional loan whether you're putting a down payment or not, depending on what you do with your money. And it has a lot more benefits than a traditional conventional loan has. So hopefully this helps. Thanks.